All right, welcome everybody to another episode. I'm here with my guest today, Jordan Knopf, who's the co-founder and managing partner at Tusk Venture Partners, which is a venture fund sitting at the nexus between technology, regulation, and politics. And we're going to unpack what exactly that means. Jordan has been responsible for a number of major investments at the firm, including the likes of Bird, Lemonade, Coinbase, Alma, Sunday, and most recently, Wheel. Welcome to the show, Jordan. Thank you for being here with me. Where does it find you, this podcast today?
So I'm in New York, right in the heart of it. Been here since the beginning of COVID and glad I never left. The city's definitely booming again.
And as we're kicking off the year, it's always a great time for predictions. And last year, you made some great predictions about fintech, which turned out to be spot on. Fintech was booming last year. You had growth round after growth round. You, with your firm at Tusk Venture Partners, you led a number of fintech investments as well, including the Series A in Main Street, which is a platform that helps startups and SMEs to claim tax credits and government incentives. Then you did two follow-on rounds, I think, in Lithic, which is a virtual cards and card issuing platform. And then, as any good investor would do in 2021, you did a Web3 investment in a NFT marketplace, digital collectibles marketplace. So you went all in with your thesis. You were spot on. Your thesis for 2022. What
So
are you excited about? Yeah.
I think that fintech is a little bit of a broader thesis, I would say, not necessarily confined to this particular calendar year or last particular calendar year. Just seeing continuous momentum. A lot of people in the tech community agree some much needed changes within financial services and in tech in general. I think that last year we saw a lot of innovation happening around the payment side and some of the more infrastructure layer. Obviously, there's a lot of tailwinds there because of COVID as well, given the rise of e-commerce and payments in general. But I think that we're kind of stepping into an era right now where we've got the building blocks and now it's time to start building up on kind of the application layer.
And Lithic, one of the companies where you, I think, participated in two follow-on rounds. I mean, it went through the roof, right? I looked back at the funding history and it just closed the Series A in 2020. And then it did two major follow-on rounds, Series B, Series C in 2021, raising north of 100 million.
Yeah, and that's look. I mean, Lithic is a company that we're really huge believers in. We're big fans of what the team has built there. And this is a company that at the time whenever we first started to get to know the management team there, this was formerly known as privacy.com. This was originally a business primarily focused on consumers and creating virtual cards to help manage online spend and really kind of protecting your own privacy with regards to cancellation of cards that may be stored for the plethora of services that many people use day in and day out. And that was a strong use case. But what we started to see and what got us really excited about this business was the B2B application. And whenever you start to see developers proactively reaching out to a management team, just asking, really curious to think about how are you feeling about building out your developer toolkit, and we'd like to build on top of these payment rails. And whenever you have developers expressing interest like that, that's typically a good sign. And they really kind of doubled down, refocused on that use case. And ironically, it's the incumbent in the space, which is not too far removed from startup land that by too many years, but is Marqeta on the issuing processor side. So it's a business that we know quite well. And it's ironic that they kind of started out with a similar path and then kind of moved into the issuing processor. And I think that really a lot of this has to do with the timing. So we invested at a time that not that many investors were. Let's put it this way. The level of activity was very different. And this was March 2020. This was COVID. Everybody just got sent to their rooms. I'm not that sure that there were that many investors that were out there writing checks in March 2020. That was that entry point. What you saw was a lot of things happening that went right at the right time. You had a tremendous rise of e-commerce, especially the early days of the pandemic. Everybody shifting to buying things online. People that had never made that transition to e-commerce, the baby boomer generation that typically were resistant against even shopping for groceries online, really their whole world shifted. And so we just saw a lot of positive movement, not just across the fintech element, but in payments in particular, and also a tremendous amount of room for innovation around the issuing processor space in particular.
Got it. Now let's talk a little bit about Tusk Venture Partners. The story goes that your partner, Bradley Tusk, he was a political advisor. He got his start in Silicon Valley in 2011 when he advised a little transportation company. And the founder at that time wasn't able to pay him his full 25K fee. And it turned out to be Travis Kalanick, and the company turned out to be Uber. And they agreed on a deal where Travis would pay half in cash and pay the rest in equity. And this little piece of equity that Bradley got is now worth north of 100 million in Uber stocks. And that's sort of how Bradley got his start in venture capital. And that morphed into now an emerging manager. You've raised two funds, a maiden fund in 2017, 35 million maiden fund, and a 70 million second fund in 2019. And at that time, when all of this got started, you were still working for a large cap private equity firm, no other firm than Blackstone, one of the largest LBO houses next to the likes of KKR. So totally different world, but you were doing there some corporate venture activities, which I understand were sort of meant to support the portfolio companies of the private equity firm. So how did you two guys meet and how did this all come together?
Yeah, no, absolutely. And just to kind of put some sequencing on there, Bradley's activities on the political side, obviously very different than my background. My background, I've been a professional investor in my career. I started out in investment banking and kind of went through that progression. Bradley had a very different experience, but he caught the bug of tech via this use case where a startup really needed something that he could provide. And this was a while ago. This was before it was table stakes to have a platform of services that you would provide to founders just to compete with other venture funds out there. And I think that's really where the story began for him and I. I was at Blackstone, as you mentioned. I spent the majority of my time there actually working for the CTO, making early stage investments and supporting a portfolio of strategic investments that were, as you could expect, enterprise software, fintech in nature that we could use across our operations or our underlying portfolio companies. It wasn't even a dedicated corporate venture arm. I joined the firm and shortly thereafter, they brought on Bill Murphy, who was the CTO at that point in time and was also one of the co-founders of Cap IQ. He joined the firm and brought over an army of people from Cap IQ. Financial services firms, typically, if you're an engineer, that's not Google or Facebook, but he wanted it to be. He was able to attract some amazing talent there and really think about things outside the box. And so I pitched him and basically said, let me go out there and find some early stage companies. And I should preface this with this is a time when the SaaS market, or at least the B2B SaaS market, had not taken off, particularly on financial services. Everything was developed in house on premise. The perception that the level of security was much higher being in house versus a SaaS business was something that was a hurdle that people were trying to get over. And basically, the thought was we can go out and take what would be a just commercial agreement for us to be a customer and become equity holders in these companies, help them think through their product development roadmap and really have it not necessarily tailored to fit Blackstone's needs, but catered to really solve for use cases where we had a very heavy foot. But that's where I really did get that dose of regulatory risk. And I just could not stop noticing that every single memo I ever came across, every conversation in the investment committee that we would talk about, there's a regulatory risk element. And it's there and there was just nothing ever under the mitigants. And I actually was introduced to Bradley via a co-founder. Actually, the last deal that I did before leaving Blackstone, which was the Series A of ETS, which is a commercial real estate SaaS platform that it's a leasing and asset management platform. It's actually a multi-billion-dollar company now in New York, but as one of the first customers of that business, really got to understand kind of a lot of the nuance that goes into pre-launch and pre-product and kind of the thought process around building enterprise software is really not thinking about the regulatory implications that could impact this business down the line. It's much more solving what's right in front of you. And the idea that I had the first interesting discussion Bradley and I had was how much better of an investor would I be if I just could just understand just how much risk is there? Look, I'm not a political regulatory person, so I don't know. I definitely didn't know at that time, but I knew that that was a blind spot, and optimizing a partnership around two people that think the same way and have similar backgrounds didn't make much sense to me. But I did have a very strong appreciation for his ability to think outside the box and come up with these extremely creative outcomes using really creative strategies that were completely foreign to me. It really opened my eyes to the world of local and state level of politics and regulation. And that was what impacts private companies, particularly the technology sector today. And so it started out as, what would it look like if we launched a fund that the focus, instead of not investing in highly regulated markets, we go right at it. That's where all the alpha should be. And at that point in time, fintech and digital health and some of these traditionally highly regulated markets, people weren't aggressively funding them. And then there was the really interesting kind of edge case, which is those really interesting companies that are building a completely new type of business model where there are actually no regulatory frameworks that exist today. And those are the white spaces that every VC on the planet is out there trying to chase. That's whenever I think we both had that aha moment that maybe there was a little bit less luck, a little bit more value proposition to that Uber relationship that he had had, and the opportunity to launch a fund that we wanted to go out and build a business that would become synonymous with being the regulatory arbitrage fund. And I think that we still to this day are. And as you mentioned, that was in 2016 when we raised that first fund. I think every venture firm has a product that they're selling, and that's the heart of VC. You have there is a financial product that you're selling to your limited partners, and that's your investment strategy and your fund performance and so on. And then there's the platform and the value proposition you bring to founders. And this was a product that I'd never heard of somebody offering. There's people that were making waves in the platform space, Andreessen. They were definitely off to the races with a huge platform offering, with business development associates helping make introductions to big corporations. First round capital was at it, helping people find the best candidates on the engineering side, but nobody was out there really kind of providing that strategic guidance on the communications, political, and regulatory front.
Bradley, he's known as the Mr. Fix-It. He's really been in the political trenches and really complimenting you. He's helped famously Mayor Bloomberg win in 2009. Then he was a deputy governor of Illinois. He was a communications director for US Senator Chuck Schumer. So he's been around, and it seems really differentiated from the outside. And in the spirit of regulation is always lagging innovation, your thesis is around that if a company or a startup is building some completely new category, especially on the consumer side, that you're there to guide them and help them see the problems ahead of time before they are dealing with 20 different state regulators, right? Talk a little bit about this thesis.
That's spot on. So look, there are certain areas that we typically shy away from investing in, and that's federal regulation. Getting something across the finish line at the federal level, people aren't going to be really confident that you're going to get much to happen in the time period that's required for a startup that's really moving through sprint after sprint and needing outcomes much faster than a federal agency can move. That's not to say we don't touch any element of the federal government. It's just not a core part of practice. Most of the regulations that impact startups today happen at the state and the local level. So if you think about whether you're trying to launch a new type of insurance company that is not going to employ agents like Lemonade, there's a lot of regulations that's state by state. You need to go to departments of financial services. You need to convince them that why it's impossible for me to have be cash flow positive for 3 years. I'm a startup. These were clearly written 35 years ago. Unless you come from that world, it's not common sense to think how much of an impact local and state level politics and government do have. It's an element that if you think about it in the context of a market expansion strategy, starts to make a lot of sense, right? Where if you can proactively get across the finish line with the New York Department of Financial Services for a specific type of exemption or a new type of business model around insurance, you could probably get other fast followers to adopt that as well, being other state governments and their departments of financial services to follow suit, and really kind of helping founders think through that sequencing and that playbook. And is this possible? Is this worth the lift? And more importantly, as an investor, how do we close the door behind us? I want to create a regulatory moat around businesses because we're trying to help shape market winners, not just move the whole sector forward. So I think that's the key part that Bradley's insights were tremendously helpful on.
And I think in some of these investments, the regulation is not just a nice to have, but it's often a make it or break it sort of thing. You had it with Uber. The taxi regulation was so harsh that at one point it wasn't even clear whether Uber would survive. Another example is Fanduel, where you participate in the Series E, and it's a fantasy sports company. There were a lot of efforts to shut it down. I think it concerns 16 different states, state legislations, and but a lot of people would say that the Tusk was really central in actually letting this company survive.
And I mean, FanDuel's a great example. And the element there is, okay, this looks and feels and smells like gambling, but somebody needs to sit there and somebody needs to have that active dialogue to explain it's not. This is a game of skill. Ironically, actually, this week, the state of New York actually is now allowing online sports betting, which was kind of that next iteration once there was a federal law that was repealed, allowing states to make up their own mind on if they want to allow online sports betting or not. And that's so FanDuel is active in that market now as well. But at the time, whenever we made that investment, this was about daily fantasy, as you mentioned. And the question around that is game of skill or gambling, which one? And having that right voice and going to the right states in the right order and helping really kind of pave the way to get enough momentum behind that to pass new legislation and protective legislation state by state to maintain this business and allow them to be operational. And then that second wave came through with the repeal of PAPSA, which is a quite famous New Jersey case that said, let's just push the federal government shouldn't really be deciding what states can do at this level, being with regards to gaming, and let them decide. And then it became this foot race of, okay, like which states are we going to go after? How are we going to strike these partnerships within each jurisdiction and get back operational there? And I think that's more of an exception than the core strategy, just given the entry point, as we are early stage investors. And typically that looks like a series A or seed type of initial entry point. This was just a very unique case.
Exactly. I was going to ask the Series E, it looks a bit late. You typically do late Series A, early Series B kind of stages. If you think about it, when does a startup start butting heads with regulators? It's typically at the scale up mode, right? When they're at the Series E, it's typically already proven out to some degree. But how do you think about sort of this interplay between stage and when the regulatory issues arise?
You're spot on in the sense that regulators are there to protect consumers, and you need to have a certain amount of adoption to really be on the radar of a regulator to begin with. Now, that's not to say that what you're doing is okay until a regulator comes in and kind of slaps somebody on the wrist. And I think that it also depends on what the actual product is. In digital health, for example, you see involvement much earlier just because the stakes are so much higher, right? Especially if there's medication involved, you're talking about some very strict laws around seeing patients across state lines, prescribing across state lines, and kind of the notion of doing things via telemedicine is not a novel idea or concept. Telemedicine's been around for decades. It's just never been utilized to its full potential until post COVID. I think that what you're getting at is we're not the firm that it is. Our focus is not to come in and help kind of crisis management situations.
And another aspect slightly related to this is sort of this interplay between consumer and enterprise. And you got your start on the enterprise side. And you could make your life so much easier if you only focused on enterprise SaaS, right? But typically, these regulatory and political issues, they arise more on the consumer side. I mentioned that before because regulations aren't typically there to protect businesses. They are there to protect the public. And so it draws you also as a fund and as following your thesis indirectly more on the consumer tech side with wonderful companies that you backed, including Bird, Coinbase, and Lemonade, all of them having a consumer angle. How does that sort of jive with your background?
Yeah, it's a great question. And look, I mean, there's just a different pattern recognition that goes into consumer versus enterprise. I don't differentiate. I'll give you a perfect example about how we'll kind of make that leap from consumer into enterprise because our portfolio is a mix. We do have B2B businesses that are in here, we made an investment into Roman, an early stage investment, and got to know digital health really well. Had a really strong thesis around it and where the world was going, especially around the ability to leverage telemedicine, particularly around stigmatized concepts and like erectile dysfunction or hair loss, and really get the treatment that's needed into the hands of people. They're just not comfortable having these conversations with the doctor face to face. The value proposition that we brought to the table there is we passed legislation to allow prescription to be done via text message. Now, that's not a catch-all for all, controlled substances and things of that nature. And it's something that we believe net is for the better good of consumers, that they have better access to the care that they need in a way that they shouldn't be subject to stigma. They shouldn't feel embarrassed about it. And they should be able to really kind of have that open dialogue with somebody, regardless of the medium of communication. Now, that was the beginning of what became kind of a pretty robust thesis that has played out. And what happened is that we saw a lot of stigmatized areas that were going to change and came up with several pretty strong theses around the way that payers would be reimbursed by providing services, or the way that providers would be reimbursed by payers, being insurance companies, for consultations being done via telemedicine. Because at the end of the day, you're providing the same level of service for certain types of consultations as if they're in your office or not. There's no reason why the reimbursement rate should be pennies on the dollar. Why incentivize people that have the bad behavior, run up additional costs in the healthcare system, and put people out of their way just to go to a physical doctor? This is really prevalent with areas like mental health and with chronic conditions, which are two areas that are also very stigmatized. Another investment, I led the Series A of a company called Alma, which is a behavioral health company based in New York as well. That was an investment that I made at the beginning of 2019. And they're a Series C company today. It was fortuitous in terms of the timing being pre-COVID. However, what we believe is that they're providing access and affordability, helping providers partner with insurance companies and be able to provide more affordable services to the people that need it the most. And the business is operating almost exclusively via telemedicine. And that was a face-to-face, in-person business that now you talk to a lot of behavioral health providers, most of them don't plan on returning to the office. And then taking that a step further on the B2B side, two investments later into a company called Wheel. It's an Austin, Texas-based company that led a seed extension round. That is the infrastructure element, basically all doctor consultations. Whether you're going through a large healthcare system, you could think big or small, from Carbon Health, Blink Health, Good RX, all the way to Mount Sinai. If you're doing a telemedicine consultation, the doctor is more likely than not leveraging Wheel. So just like TruePill provides the pharmacy fulfillment, you have Wheel powering as a white label B2B product, a compliant way to have doctor consultations, regardless of the platform. And seeing that company be built and having a very heavy hand from a regulatory and from a board capacity perspective is something that we're really excited about, what the founder there has built and what the future has in store for the business for that is ridiculous.
So, in a sense, there's a great intersection between regulation and B2B in the healthcare space in particular.
So you want to make sure that if you're diving into an industry and you're only willing to invest in the consumer companies, you're probably missing a few great
Yeah.
entrepreneurs that are operating in huge markets that you already know. You've already done the homework.
Yeah. And this brings me, I think, to the question of what would you not invest in? What does Tusk not invest in? Because as I said, you could make your life so much easier just investing in pure and simple B2B SaaS. But you mentioned in the past that if there's nothing that you can bring to the table, you're not the right partner, and that you want to have this regulatory angle where you feel like the Tusk platform can be leveraged in one way or the other, right?
Yeah. Look, we're a concentrated fund. Every fund that we have, this is a portfolio that's more likely than not going to have less than 30 unique names, which is very, very concentrated for an early stage venture fund. That's part of our investment strategy on one part. On the other, it's part of the fact that the value proposition in that moral contract that we have with our founders, that we believe in what we're able to provide them. And by taking on more and more and more portfolio companies, we're diluting that ability to give the founders the attention that they deserve and that we want to provide them. We like to keep our portfolios into very high conviction names. I mean, There's other funds that do this as well. Just to answer your question directly, the world changes really quickly. And saying I'll never do this or I'll never do that is really hard to put in concrete examples, except for one. And it's got to be in line with Bradley and myself's moral compass. If we can't look our own kids in the eye and tell them about a company that we're excited about, that we invested in without feeling embarrassed or not wanting them to know about it, it's not the deal for us.
That makes a lot of sense. You start out as a thesis fund, and sooner or later, you're going to develop into more of a generalist, and you might still have this value add and sort of high conviction subsectors and sub theses. We had a couple of examples before, but maybe let's do two case studies. And one case study where you were involved quite early on was Bird. I think you invested when it was just two founders, 8 employees, 68 scooters in Santa Monica. I was just there. It's filled with Bird scooters these days. You were at Web Summit earlier last year. You tweeted a picture of yourself in Lisbon with a Bird scooter. So it seems to be been quite the ride, taking it from such an early stage to now being a public company, going through the scooter wars, which had its own regulatory ups and downs, obviously, and even a South Park episode dedicated to the regulation of the scooters. Obviously, something that grabbed attention and headlines, and it must have been quite fascinating having the first row seat to this story.
Absolutely. And I mean, look, this is a company that's always going to be near and dear to my heart. I'll never forget that first ride on a Bird. I'll never forget the first meeting I had with Travis and kind of the first time I was pitched this idea. And it was one that you're trying to go through a traditional framework of what does this market look like? Are we displacing walking? We understand rideshare very well. We understand where that makes sense and the modality that makes the most sense to get from point A to point B. We're also New Yorkers. We're very comfortable with not taking a car ever. And so I think that we knew there was a very high unmet need within this, let's call that 1 to 3 mile radius. That's typically where most people spend the majority of their time going back and forth and traveling around. A lot of that is also watching what would happen with City Bike in New York, which was a program that really never took off the way that it probably should have. And then being introduced to a business that wanted to solve this short distance problem, not in a way of, okay, I'm just going to help people shave 3 minutes off their day or deliver a burrito 10 seconds faster than somebody else on an electric bike. This was something that was a service that now looks very different than it did, obviously, at the Series A, but there are some core elements that do remain the same. There was 1 week's worth of data that I remember that this decision was primarily predicated on. Look, we were not interested in investing into a company that wasn't going to be a twice a day product minimum. I wanted to see people coming and using this product to get from point A to point B to point C to point D and then back to their home. So 4, 5, 6, 7 times a day, like you would see with Uber. And we started to see that within the first week. I remember that 90, 95%, 96%, small numbers, sample size, but astronomical high retention. People that would take their first scooter ride if they were local, chances are they were going to take that north of 5 times a day. It was kind of this magical product. I remember first time I took it for a ride, people were jumping in front of me to ask me, what's the app that I download to rent one of them? And I'm like, what has happened? Really? Like people are honking at me in the street because there was no etiquette yet around, do I go into bike lane? Do I not go into bike lane? This was really the Wild West at that point. Bike share was there. There were people commuting to work that were men using bikes, not women. That's not as conducive for a woman's outfit or business outfit to get on a shared bicycle as it is to get on a scooter. And so what we started to see is that the adoption was very, very strong. People were using it far more often than they thought they were. And it was quite predictable how far they were going to go. And this is an area that we knew is the least penetrated part of the market that Uber had. The reason why bike share was launched, we just felt that that was an execution issue and that people needed to take a proactive approach to work with cities and actually help improve the infrastructure of these more densely populated areas to provide safe ways to get around the city. And it really wasn't the concept of in inferior product. It was actually just an inferior strategy going to work with the cities proactively to create safe bike lanes across California and New York.
And one thing that I often think about, especially if you think about Bird being a pioneer in such a space, and it's the same for Uber, that if you're the first mover, you're fighting all these battles against the cities, against the state regulators. You're chopping all this wood. I mean, Uber, I think Series C, 70 million was basically raised to fight lawsuits all over the world. And then you have the second mover swooping in and reaping the benefits.
So I mean, with Bird as an example, they were the only game in town that made that investment. Lime was still doing the bike share. They were first to market this go around. The strategy of going after the fast follower is one that, look, I'm sure this is not everyone's view. I mean, I know this is not everyone's view, but it's hard. It's hard enough of a job to find the right team, the right product, the right strategy, and to get into the deal, let alone to sit there and think, well, maybe someone else is going to come around that's going to just replicate this product and like execute on it in a better way than the visionary that came in to begin with. That's just not a strategy that I'm going to follow. The strategy that I'm going to want to take is say, what kind of moat can we build around this business that actually closes the door behind and creates a gold standard where that second mover, third mover, fourth mover, let's set the bar to what they need to be compliant in this way to launch in a market. The only way to do that is to proactively work with the government to really set those regulations in place. And that can be very difficult to do if you are the second move. We've seen plenty of businesses like this. Whenever you're onto something, you're onto something where people will pivot business models very quickly. And I tend to think that innovation is quite persistent. Typically, founders that have a phenomenal idea, they tend to have more than one and they figure out ways to execute on those business ideas in a way that someone who just might have replicated a model is chances are they're probably going to be trying to replicate things in perpetuity. Right. It's a constant game of catch up. Economically, you can do okay. I've yet to see a VC pitch themselves as their investment strategy being around the second mover. There are strategies that we've been part of. There's one thing that's constant: states and cities, they at least need to provide the notion that they have a balanced budget. They're typically incentivized by additional tax dollars or revenues for registration fees. And so with Fanduel, we're quite happy whenever the notion of, okay, pay to be licensed in this state to operate a daily fantasy sports product, it costs $1 million. And I'm just making up numbers now. But if you're the first mover and you've raised enough money, now that's an opportunity for you to close the door behind you because most early stage new market entrants aren't going to be able to pay $1 million to every state to launch. So I think that's a big element here. And I think that in these land grab scenarios, every case just tends to play out differently. But I think that just as they were the first mover in getting a product to market, they're probably the first mover in finding top talent. It just trickles down to other elements of the business as well.
Yeah, gotcha. I mean, once you've gone through the whole process, you have all this money invested in this business, you're really at the starting line once sort of the floodgate opens and you have bright line regulation. You're there to execute and you pay the licensing fee in the case of Fanduel. And then there's another interesting case, which is that you have a large incumbent and he's getting into legal troubles and regulatory troubles. And that was sort of maybe not the entry thesis, but at least it played a part in your investment in Sunday, which is a D2C lawn care company. And you had an incumbent Roundup, which was going through a class action lawsuit. And basically, you came in with a more sustainable solution there. And that's sort of a different strategy where you see an incumbent struggling with regulation and you see sort of a white space coming in with a new novel solution that's more geared towards regulatory clarity.
Yeah. So I led the Series A in July of 2019 into this company. And it was one where there was a big lawsuit that was underway and perpetually underway with Bayer and Monsanto for Roundup, which eventually, after many, many, many times in court, it was linked to cancer. I feel very fortuitous to be as involved as I am with this company and sitting on the board with some absolutely top notch other investors as well, and a founder that has a mission that has been top of his mind. This is a Boulder, Colorado based company that everything that you would envision, right? Like, this is not a Silicon Valley business. This isn't a New York City business. Here's somebody who genuinely cares deeply about the environment. And that was part of the thesis that we had of the next generation of homeowners are very different. This is also informed a little bit by our investment in Lemonade, right? Like Lemonade, we see the data. We know that people are moving from the cities to the suburbs. They're first time home buyers. First time home buyers are also DIY lawn and garden people. But most people don't really know much about, let me I'll be the first one to admit I'm sitting in an apartment building right now. What do I know about taking care of a lawn? I know that I want to remove complexity from it. And I know that we're not really DSC investors, but we are if it's the right offer. This is a direct to consumer product because that's the best method of delivery because it only shows up whenever it's time to apply it. It's not a way to get to market faster. It's a way because it's a customized product that's geared towards providing you with the exact product that you need and the exact recipe and the balance that your lawn needs so that you can just apply it, know nothing about what you're doing, and your lawn's going to look amazing, especially if you're walking down the aisles of Home Depot looking at various giant bags of poison. It's a tough pill to swallow if you want to just take that on as a Saturday after event. You're probably just going to get that done professionally. So here what we saw was that an intersection of consumer trends where the calculation used to be, am I willing to pay extra for an organic product? Or how much am I willing to go out of my way to go green? Am I willing to get my product shipped a little bit later? And those tastes and preferences changed from a more economic decision to I'm not going to have anything to do with a brand that tests on. I'm not going to have anything to do with a brand that isn't sustainable. I'm not going to work at a company that doesn't instill the same values I have. I'm not going to put their product on my lawn. I don't want it in my house. I don't want my kids coming into contact with it. And I don't want neighbors that are using products that are going to get onto my lawn. And so this is a product that's D2C because it's shipped to you just in time for you to apply it to get the best results, even as a novice. And we saw just this intersection of a great time when people were moving to the suburbs that were going to be first time homeowners that are much more inclined to take care of those initial projects themselves. Also, that have a newer set of values that really the environment and climate change is at almost the top. It was the right time, the right place, the right founder, the right product.
Interesting. I noticed it was one of the few, if not the only D2C company in your portfolio. And so I dug a little bit deeper, but interesting to learn about the thesis around it. And so, Jordan, as we're over the clock already, I want to finish this episode with finding out where you're spending most of your time in 2022. What kind of areas are you excited about? We mentioned digital health before, gaming, fintech, probably Web3. Tell me what you're excited about, what you're looking at, and what kind of investments we can expect from you.
Yeah, I mean, look, I think that just like a lot of investors out there, we're still really excited about what's underway in fintech in general. Web3, I think, is going to present a plethora of great investment opportunities. I think that we're going to continue to see the unbundling of financial services as they were, still are somewhat sold to date under the legacy model. Learnings from previous investments that have made is that the biggest demographic that is purchasing financial products today. 5 years ago, a lot of people thought that millennials and Gen Zs would just be living in the moment, not really caring too much about their financial health, not valuing ownership as much as kind of living in the moment. Turns out they're far more savvy managing their financial lives than probably other generations have been. And they love financial products. They just don't like to be sold. But giving them the ability to take more agency over those decisions is imperative. And that's an area where I'm spending astronomical amount of time. We've made several investments in the space. Some have been announced, some have not, that I'm extremely excited about that are really changing the dynamic around the way that financial products are distributed, who has access to them and who doesn't, and this convergence around access to the best in class financial products at affordable prices and not putting on barriers that are not necessary in place to preclude people from taking more agency over their own investment decisions. I think if anything, this pandemic has shown people that, or has shown us that people are very comfortable, particularly the millennial generation. Look, they value people's opinions, they value professional financial advisors and so on, but they're very comfortable in taking the bull by the horns and really executing on a plan that's very well researched and that they can put in place themselves and providing them with the tools and the platforms and the technology to do so is imperative. We're going to continue to see that kind of bifurcation out of these very large banks that aren't meeting their consumers where they are. They're trying to be the solution for everybody, but unfortunately, that leaves far more people without access to the right financial products that they need, whether that's to run their own business as an entrepreneur or really kind of just to live their day to day life. And I think that we're going to see a lot of radical changes on the consumer behavior side. We're going to see bigger financial institutions be a little bit too slow to adopt to it. And hopefully, some new market entrants come in and show them how it's done.
Yeah, I like it. I mean, it was Andy Ratcliffe from Wealthfront who said that was his key insight for Wealthfront, that millennials, they don't want to talk to bankers. They want to do all the transactions, but they don't like talking to bank clerks.
I would take it a step further and say, like, I feel like they're a lot more comfortable with the kind of the setting their own asset allocations and picking their stocks. What's fascinating about it is they're not necessarily looking for the prudent target date portfolio. We just brought up Sunday a minute ago. They want access to invest like people that have the same values that they do. My wife is a animal rights activist. She obviously is a big fan of Sunday. She's also a hedge fund trader. She's very proficient in where to invest her money, but what she have a huge interest in being able to put capital behind a money manager that says, I want to take animals out of the supply chain. It's not just about investing in the most lucrative financial return stream. For a lot of people here, there's a segment of their asset allocation that they want to put behind causes that they care about, people that they believe in, and that not necessarily the talking head on CNBC or the person running a Vanguard fund. That's where we're starting to see this intersection of the creator economy with people with those more outspoken voices and unique opinions that aren't necessarily in the financial services industry create quite a following.
Yeah, understood. Talking about the creator economy, and we're just finishing up this podcast. Jordan, thanks so much for being with us here. Where can people find out more about you and sort of keep in the loop with what Tusk Ventures is up to?
Well, thanks for having me. And absolutely, people can follow me on Twitter at Jordan Knopf. They can visit our website, tusk.vc, and feel free to reach out to me directly via email, jordan at tusk.vc at any time.
I think that's the first that someone mentioned his email. That's great.
It's not that difficult to just put my name in front of the domain. So let's just put it out
Let's just
there.
do it. Let's just do it.
Brave new world. It's a fresh beginnings. It's 2022.
Love it. Love it.